Welcome to BT Podcasts. In this episode, get clarification on directors' duties, liability, and the impact of the Goh Jin Hien judgment, plus insights for corporate governance in Singapore.
Imagine as a director of a company, you're accused of sleepwalking through your job and then sued to the tune of $156 million. That's what almost happened to former Inter-Pacific Petroleum non-executive director Goh Jin Hien. Lucky for Goh, a June 5th judgment overturned a prior ruling that ordered him to pay that amount in damages to the insolvent marine fuel supplier. And this judgment has clarified the scope of directors' duties, offering relief to other company directors who are understandably shaking in their boots, I reckon. So what exactly does this mean for directors of companies moving forward? Welcome to BT Podcast by the Business Times. I'm Howie Lim. And joining us today with his insights, Robson Lee, a senior corporate finance lawyer with over 30 years of experience in corporate governance, currently a partner at Kennedy's and a director of Legal Solutions, LLC. Robson, always good to speak.
Thank you, Howie.
Let's start with how that recent win of Goh Jin Hien in the appellate division impacts the perceived responsibility of company directors here in Singapore.
I think the important principle to draw from that case is that although you might be negligent, although you might have been less than careful to have any compensation expected of the director in question, there must be a clear nexus between his negligence and the loss caused to the company.
What are some other practical implications then does this judgment have on the criteria for holding a director liable then for company mismanagement, Robson?
First and foremost, the director, putting aside what could possibly be sued against you for damages or liabilities, you have to continue to be vigilant when you are a director, and this is irrespective of whether you're an executive or non-executive director. Your duty of care, your duty of due diligence remains. At the end of the day, of course, if someone sues you, whether is it the liquidator of the company that has gone belly up, or shareholders going after you, or new board of directors going after you for tardy management, that's a separate point, because then the plaintiffs would have to prove that your negligence directly or indirectly caused a loss to the company and consequently losses to shareholders and other stakeholders.
Is it then that the judgment doesn't really clarify the boundary between, say, a director's duty to monitor and the standard of care expected from them? Does this judgment at all clarify this?
Well, the judgment, on the contrary, reinforces the importance of being very careful, being very professional in your dealings with the company, in verifying information before you sign, before you approve any transaction. So nothing changes as far as that particular judgment is concerned. So at all times, be careful, be alert to what's happening, ask questions, exercise due diligence so that you can raise the defense of due diligence. You can also raise the defense of reasonable reliance, i.e., if you find that there's something funny on the accounts and you check with the financial controller and what he or she has produced for you looks reasonable, looks perfectly explainable, then I think you would have discharged your duty of care. So relying on, for example, the CFO, the Chief Financial Advisor, telling you that, the accounts are done properly, there's no hanky-panky and everything looks, above board, then you would have discharged your duty of care. If I may add, I think it's important that when you're carrying out your duty of verification, have that in writing, send emails, and get email or confirmation in writing from the persons that you reasonably expect to rely on. For example, external auditors or the CFO or even the CEO. Because if at the end of the day, someone wants to defraud the company, someone is acting in concert to deceive the board, then there's really nothing that you can do about it because documents can be concocted. And if you have done all the reasonable checks, all the reasonable verifications, then you are on the safe side of the law.
I feel like the impact might be that it'll just take more time then to do one's job, it feels.
No, actually, that has always been expected of directors. The cardinal principle in that particular appellate judgment simply state that, well, you can't just go after a director, although he might be negligent. You have to prove that his negligence caused the loss. It's the sole or principally the causative factor that led to the company to suffer losses.
So then how might this judgment influence the behavior of directors in terms of how they then engage with company operations?
Well, it reinforces the importance of not being a sleeping director or sleepwalking on your job. Beyond that, it gives a certain assurance to directors that while you may have been less than careful, it does not necessarily mean that you have to be responsible for the hundreds of millions of losses suffered by the company, because the plaintiffs have to prove that your act of negligence caused the losses that they are coming after you.
Still to come, why it's important for directors to have liability insurance, and what other high-profile cases are possibly shaping directors' duties as well. More with Robson Lee in a moment.
And now back to BT Podcasts.
Welcome back. We're speaking to Robson Lee about that really huge case where June 5th judgment overturned a prior ruling that this particular director needed to pay $156 million in damages because he was sleepwalking through his job. Robson, to what extent should directors then be involved in the daily operations of a company, since they want to avoid breaching their duty of care, right?
Well, if you are not an executive director, I think it will be too much to ask of you to be involved in the day-to-day operations. But at the end of the day, as a director, as an independent director or as a non-executive director, you have to make sure that the company has adequate financial controls, that there are risk management measures, and that you have people who are carrying out all these internal control systems that the board has a duty to put in place. So while you may not be involved in the day-to-day operations or be actually involved in the executive functions of the board, you can discharge your duty if you ensure that you have a system of check and balances, and that from time to time you got to verify that these things have been carried out. So it's important then to have internal auditors reporting to the Auditcom chairman, and that you are a member of the audit committee, that if there's anything that's irregular, the internal controls would be able to surface this, and internal auditors would be there to report to the audit committee to ensure that there is no countermand by executive directors, that at the end of the day, things are functioning as they should be. And of course, at any point in time, if you are not comfortable with things that are coming to you for approval, ask questions. Do not just rubber stamp your approval because there is some urgency or purported urgency that they need your signature quickly and that they give you very vague answers. Don't sign. Ask questions. Put that in the email and expect a response in writing to your questions. I think that's something that you have to put in place. You do not have to micromanage or major on the minor. But having said that, it is your duty to make sure that there's a system of check and balances, there are internal controls, there are internal auditors, and that you have also put a system of whistleblowing. Because at the end of the day, certain employees may raise the red flag confidentially to the members of the audit committee to say that something improper is happening. Someone is doing something that is not correct, that may even be illegal. So it's important to wrap up your duty of care. Not only you must have an adequate and robust system of corporate governance, internal controls, risk management, there must also be a comprehensive system of whistleblowing, and that whistleblowers must be protected, because at the end of the day, you don't want the whistleblower to suffer the repercussions of blowing the whistle, so to speak.
Robson, we alluded to it earlier, liability insurance. Why is it important then for directors and officers to have this? Also, what sort of things should they consider when they're acquiring such insurance?
Well, the purpose of having a directors and officers liability insurance, or D&O for short, is to make sure that for whatever reason you are being sued, whether by the liquidator, by disgruntled shareholders, or by a new board of directors that have taken over the company, you want to make sure that you are not overwhelmed by legal bills because in a long drawn-out lawsuit, it can cost you a lot of money. And that has happened before, where directors just simply give up because they just don't have the money to pay for the legal bills that are mounting. So a D&O policy helps you to defray, helps you to pay off the legal bills as you are fighting to prove that you have not been tardy, you have not been negligent. So it's important that when you take on the appointment of a director, make sure that you read the fine print and the whole set of documents from the insurer to make sure that certain events are properly covered. There could be lawsuits mounted just to bulldoze their way, to cow you into submission. Then you must have that safety net to make sure that the insurance coverage is adequate to see this through. D&O doesn't cover criminal liabilities, I must add that. So having that safety net in the form of a D&O insurance does not lighten your duty to be careful, because at the end of the day, not only you may find that you are being sued in a civil law suit, you could be also charged by the state for being negligent, for being tardy, that you have failed in your duty of disclosure, you have not complied with what's expected of you in a listed company by SGX rules or by the Securities and Futures Act. So that's only a safety net, but it's not an absolute protection. Nothing beats you being very careful, very alert, ask questions. When in doubt, don't sign, don't approve.
There have been some other high-profile cases along with IPP. Would you care to maybe share a little bit about, say, how those cases may further shape the interpretation of directors' duties in Singapore?
Well, there are a few high-profile cases at this point in time, High Flux, for example. But I'm not going to comment on that because what I understand is that even the independent directors are now being charged by the state, by the Attorneys General Chambers. Outcome of it is still unknown, but it underscores the importance that if at the end of the day you have not done your job properly, you do have that exposure that not only do you face civil lawsuits, the state could come after you. And then you got to make sure that your D&O is there to cover your legal expenses, because it's going to be very drawn out. It could last for years. So while most people are careful about signing as a guarantor for someone's debts, people tend to take up directorships as a badge of honor. But with that badge of honor, it also means that it carries onerous duties, onerous responsibilities that could bankrupt you, could land you in jail. So be careful about taking up appointments as director, particularly if you are not involved in management, because there are a lot of things that could happen that could pull wool over your eyes. And if you sign, you didn't ask enough questions, and then you're found to be negligent, not only do you run the risk of being charged in court by the state, you could face civil lawsuits unless, like in that IPP case, the court is able to establish that your negligence, your tardiness did not cause the losses. It was not proven by the liquidators that the negligence of the non-executive director in question had caused the company to suffer that 150 million losses, which they were going after that particular director in question.
Any last-minute advice, Robson, for directors to ensure that they actively fulfill their role, but also don't go into micromanagement and being too freaked out about everything?
My closing words are that be careful. When in doubt, don't sign. Do not just simply approve something because management tells you it's urgent. We need it tomorrow morning, and then you are in some far-flung place, a different time zone, and you sign off because you are about to tee off for a golf game. Don't do that. When in doubt, ask for legal advice, ask for financial advice from professionals so that you can raise the defense of due diligence and the defense of reasonable reliance. Because if you have taken legal advice, if you have taken professional financial advice from reputable professionals, then you can say, look, I've done all this, and I've also double-checked with this particular law firm. I've also double-checked with this particular financial advisor. Nothing has come to my attention that led me to believe that there was any hanky-panky around.
Sounds good. I wish we had more time, Robson. Thank you for your insights today.
Thank you, Howie.
This has been BT Podcast by the Business Times. I'm Howie Lim.
Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.